excited to invite our next guest up. We're going to be doing a fireside chat. I'm going to be joined by Mark W. Yusko, who is the CEO and CIO of Morgan Creek Capital Management and the managing partner of Morgan Creek Digital. Thanks so much for joining us. Please round of applause for Mark.
Thank you. I would say I appreciate you getting the applause out of the way before I talk.
Nice. Well, Mark, first off, you have Seattle roots. So
I do. Grew up here all my formative years from 4 to 16. So I left a long time ago, but the last thing I did before I left was climb Mount Rainier, and flying in today was out in all its glory, so that was kind of cool.
I love it. I'm glad that you were able to reminisce there. We've had your co-founder here in the past at Morgan Creek.
I saw that little child up here, Lil Pump, was up here earlier on the 2018 stage. So
yeah, so really happy to have you. Before we kick this off, I would love to understand, because you've been on the capital management side for your whole career. Is that
yes.
Right?
Yeah. Yep.
Okay, so you've been on the capital management your whole career. You've done in where we're at crypto world, traditional deals.
Yeah.
Take us through your reasoning to even, not even the fact that you did it, but even considering this.
No, why did I make this huge mistake and come into this side of the world? Because that's what I've been told over and over again. Look, I'm old, first of all. I got white hair to prove it. Been around the investment business for a long time. Didn't plan it that way. I actually grew up here, then went to 3 high schools, hated my parents, ended up at Notre Dame, wanted to be an architect, didn't like that much. Dad wanted to be an engineer, didn't like that. So ended up pre-med, didn't like that either, didn't have a good reason to become a doctor. I'd worked up at the ED up in Everett, and it was awesome. The guys worked 8 days a month, 24-hour shifts. They'd sleep most of the time in the back room. Nurses did all the work, and they all drove Porsches. I'm like, that is a really good job, so that's what I want to do. But when they ask you that question on the med school app and you write that down, it just looks really bad. So didn't go to med school. You have two choices when you come out of business or undergrad with a pre-med degree. Don't go to business or to med school. You can be a pharmaceutical sales rep, or you can be a consultant in healthcare. I'm not 6'4" and handsome, so I was not going to be a pharmaceutical sales rep. So I was going to work for Anderson Consulting back when it was Arthur Anderson here in town. My dad had been a partner for many years, and I didn't want to be Bill Yusko's son, so I went to business school. Then I just took a job at an insurance company, and the guy doing investments retired, started managing bonds. Then I took a job with the very first quant shop. These guys invented low price to book investing. The guy's still pissed that Gene Fama turned the thing over, called it Book to Market with Ken French, and got the Nobel Prize. Bill Breen was like, I invented that like 10 years before you. But that's the way academia works, whoever gets the notoriety. So we had $1 billion back when $1 billion was a lot of money, but I got the call. So I got a call from my alma mater at Notre Dame. They wanted me to come back and work in the endowment office. And that's where I learned that investing was not about picking stocks and bonds. It was about picking asset classes and big trends. And I had my aha moment in 1996. We made a little investment in a company called Sequoia, which at the time was not famous. And there was this guy, Don Valentine. He just hired this guy, Michael Moritz. The other partners were pissed. Michael had never done a deal. He was a Wall Street Journal reporter. Don decided he liked him, brought him in. Turns out Michael was a pretty good investor. First deal was Yahoo. Second deal was this little company called Google. We put $500,000 into Google. It turned into $200 million. And I went, okay, this works. So that's when I realized that infrastructure around tech evolution was really important. And so over the course of the last 20 some odd years, I've gone back and I've looked, and my life resembles this technological evolution. So my dad sold mainframe computers back in 1954. It was a little company called Digital Equipment Corp., founded with $70,000 of venture capital out in Route 128 in Boston. That was the center of the universe. The center of the universe was not Palo Alto. It was Route 128 in Boston. 14 years later, there was an innovation out in Silicon Valley out of DARPA around the microchip, and this little company, Fairchild, and this guy, Don Valentine, invested in this little company called Intel. You've heard of it. And 14 years later, here, there was a little innovation around the personal computer. Many of my friends don't work. They all went to work for that little company you guys know called Microsoft. They don't work anymore. I was too stupid to go to work there. My bad. Although I always defend myself, which I shouldn't say in Seattle, but if you ever seen the picture of the original Microsoft 11, you don't blame me. Now look, they're all multi-billionaires and I'm not, so I shouldn't make fun. But we all looked bad in the 70s. I mean, we looked bad. That group was rough. I mean, they didn't wear the beard as well as you did. But I didn't do that. So Steve Ballmer's mom famously quipped, honey, why would you work for that company? No one would want a computer in their house. She was just quoting the DEC CEO. And you'll notice a trend that every time an innovation happens, the incumbents poo-poo it, right? They basically say it's stupid, right? The inventor of the telegraph, Western Union, this chairman said that it was impossible to transmit the human voice over copper wires. So the telephone could never work. Well, of course he would say that. And then the father of the telephone said that radio would never work. Well, of course he would say that. And then the founder of radio said that television would never work. And then they said that cable TV won't work and John Malone will fail. And you get the point. And so 14 years later, and why it's always 14 years, I don't really know. I think it has to do with the creative class is always young people, right? You know, Mark Andreessen was 19 when he invented the browser. Larry and Sergey were in their 20s. So it's always young people. And the reason is because they don't know what they don't know. And again, it's not politically correct anymore, but when I was growing up, there was this comedian named Bill Cosby. Now he's a bad guy. But he had this funny thing where he talked about this kid. And the kid would drive his bike, or ride his bike, over the swing set and across the top and on top of the fence, and then these little 360s, 6 inches off the ground. He never fell. You know the first time he fell? When someone told him about gravity. Because he didn't know what he didn't know. And so young people start these great businesses. So in 1996, Larry and Sergey created this thing, Google, and no one could understand. I remember saying to the guys at Sequoia, why? There's 20 search engines. Alta Vista is great. Web crawler, awesome name. Ask Jeeves. Okay, that was a bad one. But there were 20 search engines. What do we need 21? Well, they didn't do search. They created an entire... You guys know, there's 1.7 billion websites in the world. Google owns half of them. Every time someone types a question, if it hasn't been asked before, they create a new website. It's amazing. So that's why it's so fast, because they indexed the whole world. So they didn't make search better. They made something new. That's innovation. So then in 2010, I was actually back here at Craig McCaw's house, family office, for an event. I said, do you think the mobile net is going to be as big as the internet? He's like, Mark, you kidding me? Ask me if they want a computer, like whatever. Ask them if they want a mobile phone. Like, I already have 2. I left my 2 back there. So I have 2 phones. I don't need another one. So yeah, the mobile net was bigger than the internet. And remember when Google, again, bought Android? Yeah. 2005? Cover story, Business Week. Dumb investment. What do you know about operating systems? Well, they know a lot about operating systems. They have 80% market share globally. Apple's 19%. We all have iPhones, but everyone else in the world has Android. And so they knew something about infrastructure. So in 2024, which is still 2 years from now, or a year and a half from now, that's the trust net. So we went from the internet to the mobile net and the trust net. And the way to think about this is parabolically. People are bad at math. 2 times 2. 4, good. 17 times 23. I'll wait. That's the limit of human intelligence. The average person cannot do that without a calculator. 17 times 23, it's not that hard. But people can't do it without a calculator. So how are you at nonlinear regression? If I take 20 linear steps, I'm to that light that is shining in my eyes that I can't see. 20 linear steps. If I take 20 exponential steps, I go around the world twice. So we had linear growth in Web 1, and we created unbelievable wealth. I told you, we put $500,000 into this little company, took out $200 million. Unbelievable wealth. Google, Microsoft, Intel. Great, that's Web 1. And think of that as the area under the curve of a parabolic line parallel to the x-axis. Then we have the knee of the curve, that's Web 2. More wealth. First trillion-dollar companies, multi-trillion-dollar companies. Google, Apple, Netflix, Alibaba. Incredible businesses. But now we're going to go parabolic. Now we're going to Web 3. And the wealth that's going to be created in Web 3 makes Web 1 and Web 2 look like a warm-up act because they were building on shitty tech. Yeah. Like client-server technology was horrible. I mean, I remember my first PC that I bought from Michael Dell from his dorm room. I should have saved it as a collector's item. It took 3.5 minutes to boot up. 3.5 minutes. And it had a big old floppy disk. And that was state of the art. But now, state of the art is building on really good tech. And so, someone said pets.com earlier today, right? That was the epitome of the failure of the internet, right? Chewy.com is the same freaking company. It's worth $20 billion, or a little bit less, but it's the same company. Webvan, Amazon, I mean, kind of the same, or DoorDash, kind of the same thing. But one went bust, it was just ahead of its time. And so, a lot of things are going to fail. Someone said earlier, I think Rahul said 97%. Yep. Pre-seed stage venture capital, which is what most of the shit coins are. So there's cryptocurrencies. There's about a dozen. Then there's some projects that are pretty interesting, L1s, L2s. And then there's a whole bunch of utility tokens that are just crowdsourced pre-seed stage venture with no rights. Yep. Like, at least if I do venture capital, I own equity, I get a bond, a convert, I own share cash flows. With most utility tokens, I don't own squat. So why do people do that? I don't know. But most of those are going away. But the ones that don't, some of them will change the world. And did I answer your question?
You did answer my question.
I just got going on a rant.
Normally I would interrupt someone because I would think like, oh, like you're kind of going on this tangent, but that was literally history right there, just telling us how this, so I'm really thankful for that.
Oh no, so I didn't answer. I did not answer your question. So how did I get here? So I lived this life about technology, and I'm not a technologist, but I lived this life being exposed at the right time, and I went from my alma mater at Notre Dame to North Carolina back in 1998. I invested all in the mobile net throughout that period, and then I left in 2004 to form Morgan Creek. And we brought the endowment model investing to us first. Tiffany, I saw it was OCIO. I actually coined the term OCIO a gazillion years ago. I didn't invent the business, but I coined the term. And now there are lots of OCIO firms, and we've kind of left that business. And now I spend all my time as a venture capitalist because I transitioned. And so the quick version, I promise that this will be quick. 2013, I got introduced, the same month as the Winklevoss twins. There's a book about them, not about me. They're multi-billionaires, I'm not. Why? Because they got it. I was skeptical. May 2013, Dan Moorhead, who's a good buddy, runs Pantera, said, come to San Francisco, I'll buy you dinner. He said, I'm shutting down my hedge fund. I'm going to spend the rest of my career in blockchain and Bitcoin. I was not running drugs on the Silk Road. I was not a cryptography student. I did not understand Bitcoin in 2013. I'd heard about it. I kind of, yeah, whatever, but I didn't get it. But as soon as he said picks and shovels, I'm like, yes, I'm in. And that first fund's up like 17x. No one's complaining. That's good. Should have put the money in the Bitcoin fund. It's up 350x. Best performing fund in the history of hedge funds. But I didn't. Why? Because everyone I told about it said, you're an idiot. Don't talk about this. 9 months later, I wrote one paragraph in a 40-page letter. One paragraph in a 40-page letter saying Bitcoin is an interesting special situation to my clients. It was priced at $500. I got hate. I mean, hate. Like, we'll fire you. You're an idiot. Don't talk about magic internet money.
And that's people that you manage their
yeah,
capital.
I mean, we had billions of dollars of capital under our advisement. I'm saying put 0.5%, 1%, just a little bit into this thing, and you will be happy because it's uncorrelated to all your other assets. It's a great diversifier. Hate. I'm like, okay. And it went from 500 to 186. I'm like, oh, see, they were right. And then went from 186 to 1,000 in 8 weeks. I'm like, no, they're not right. So my son graduated in 2015 from Notre Dame. I said one word, not plastics. I said blockchain. I said go. He wanted to live in San Francisco his whole life for whatever reason, don't know. I said go see Dan, go talk to Coinbase, get a job at Coinbase. So he comes back and says, Dad, I don't know. Maybe it's going to be a big deal. I'm just going to go KPMG. It's safe, you know. I'm like, you're going to hate it, which he did. He hated it. Quit after 9 months without a job. Who quits without a job? It's like a millennial thing. I'm like, you get another job first. You don't quit. He went 9 months without a job. But to his credit, he never asked for money. And I'm really proud of him. He works for Snowflake now, so he's doing fine. But the key is, he's like, I don't think it's going to be a big deal. Now, when Coinbase went public, he did call me and say, all right, fine, Dad, you were right. But you're not as smart as you think you are. I'm like, oh, do tell. I told you to work at Coinbase. He's like, yeah, but you didn't lever up the house and call him Bitcoin. I'm like, you shit. Yes, that is fact. And so, second of my many bad decisions in this space is I didn't lever up the house and put all in Bitcoin. But by 2016, I finally got clients to invest. We invested. And you saw Pomp's picture a couple hours ago. And I met Pomp in 2017. And it was one of those things where I started following him on Twitter. It's like. It's like, that's something I would say. That is something I'd said. I need to meet this guy. So we had breakfast. Breakfast turns into lunch, turns into dinner, turns into the next day. Like, we got to work together. So we were going to do what we always did. We were a fund-to-fund shop that did co-investments. We decided, he convinced me to flip the model. He said, we're going to be one of the, he wanted to be the best venture capital. I'm like, come on, there's a few other competitors. Now, at the time, there weren't a lot. There was Blockchain Capital. There was Pantera. We were number 3. And Polychain didn't exist yet, and A16Z crypto didn't exist yet, and Paradigm didn't exist yet. And we went out to raise a small amount of money because people thought we were idiots, and my wife thought we were idiots. Everyone thought we were idiots. We raised $40 million. But the key was we got a big pension fund to give us money, and that changed everything. That first fund's done really well. The second fund.
And actually, I want to dive into that for just a second. So I know that for the most part, pension funds are fairly conservative in their investments. If I'm correct, and correct me if I'm wrong, they'll have maybe a small allocation that they might do to
Most
a high
have zero.
risk.
Most have absolute zero. In fact, I spoke to CIBA, which is the Corporate Investment Executive Benefit Association. 120 of the largest pension funds in the world. This was like 8 weeks ago. I asked them 5 questions. How much do you have in crypto? 0, 0 to 1, 1 to 3, 3 over 5, 3 to 5. If you have 0, why? Like, what's the reason? And do you have any plans to change? And then a couple other questions. 83% bupkis. That's why I have the hashtag #GetOffZero. Look, 0 is the wrong number. 5 years from now, well, 3 years from now, I used to say this 2 years ago, if you have 0 exposure to digital assets and you're a pension a fiduciary, you will be deemed fiduciarily derelict of duty. Now, today, they're still afraid, but the killer one was 63% said no plans to change. So we're still really early, and it's coming, but pensions are crazy, crazy conservative. They're bored. So there are 2 visionary CIOs, Catherine Molnar and Andy Spellner, and they came down, they brought their board for a full day due diligence in North Carolina, and then we went up to do their board meeting. 2.5 hours of grilling all these questions, and long story short is, at the end, this is the Uniformed Police Officers Pension Fund. The chairman, uniformed police officer, helmet and gun on the table, sunglasses, full uniform, Harley outside. I could not make this up. He looks at me and says, Mark, I hear everything you say, but you want me to tell my guys that I just voted to put their retirement in drug dealer money? I'm like, no. Well, I see your point. No. What I want you to say is, as a fiduciary, you have to make 7.25% actuary assumed rate. The only way to do that in a 2% world is to invest in innovation as an asset class and in alpha. And in order to do that, you have to invest in venture capital, you have to invest in innovation. This is new innovation. He's like, all right, I can get behind that. The next day, Washington Post, pension fund invest in drug dealer money was the headline. I'm not making that up. And he was quoted word for word saying, no, we're fiduciaries. We need to invest in innovation as an asset class. And so they're incredibly conservative, and that's why we have 1 or 2 pension funds. We have a couple other institutions. A16Z has been successful in kind of breaking the barrier. They just raised more money than God. Glory to them. And a few others have gotten a little bit across the blood-brain barrier. But most of innovation in investing comes from family offices and individuals, because there's a great line, I don't remember who said it, but I stole it, so now it's mine. But an investment committee should be an odd number, and 3 is too many. Because groups don't make good decisions. Individuals make good decisions. That doesn't mean they're always right, but they make good decisions. They make fast decisions. Groups always make bad decisions. Like, if I ask this group, what's the best restaurant in Seattle? I would get McDonald's. If I asked you individually, I'd get awesome answers. But if I asked the group, everyone's, I don't want to say Thai food, or I don't want to say what we just had for lunch, which was great. I'm going to give you something continental. Well, not continental, maybe a steakhouse. No, you might not like steak. Just go to McDonald's. No, groups make bad decisions. So what you see is family offices are first, individuals, then some innovative foundations, endowments who have good leaders, and a few pension funds. and then the sovereign wealth will follow, but the big money is still yet to come.
Yeah. And so you being an innovator, from coming in traditional to now, since then we've seen, the Paul Tudor Joneses of the world, Kevin O'Leary, who everybody probably knows from Shark Tank, these people who were actually before very anti-crypto.
Oh my God, Kevin and I went toe to toe on Power Lunch on CNBC a year and a half before he became suddenly all enamored.
Yeah.
And he's like, no, this is a Ponzi scheme, this is zero. I'm like, no, your Ponzi scheme is Amazon at $2,000. It's gonna be dead money for a decade. He's like, no way, that's impossible. Still $2,000, Kevin. Now it went to $3,500, I'm not saying it didn't, but it was all in the price. And there's no company good enough that you can't screw up by paying too much. And there's no company bad enough that you can't fix with a low price. So investing is about discounting the expected and betting on the unexpected. And so at $3,500 is priced for perfection at Amazon. And today, Bitcoin at $30,000, right below fair value, really, Bitcoin has only been cheaper to its history 6% of the time in 13 years. So investors buy what's on sale, right? My job as an investor and as a steward and as a fiduciary is to buy things when they're on sale. And the only way you can do that is if you have conviction from doing the work. In fact, I literally just tweeted this out while I was waiting to come up here. The problem is speculators, and I can't remember who said it, but the market today, particularly in Bitcoin, less so in crypto, is all driven by speculators because the hodlers control 2/3 of the assets. Right. 2/3 of the Bitcoin haven't traded in over a year. That means the free float of the asset is very low, and it's constantly driven by speculators. And this is not politically correct, but it's mostly guys. Why? Because we're hunter-gatherers and we only see movement. Like my wife says, go get the ketchup. I open the fridge, there's no ketchup because it ain't moving. She walks up, grabs the ketchup bottle, says it's right there. But I can't see it because it's not moving, all right? And so when prices start to move, all these young day traders, and it was worse in COVID, we locked people in their apartment. We wouldn't give them gambling. They couldn't go to Vegas. We gave them free money, and then they start speculating on crypto, and then the price went up, and they're all enamored. And the worst thing that could possibly happen, they made money on their first trade. Yeah. So now they think they're smart. And so in gambling, right, so there's 4 types of market participants. There are investors, people who buy things based on their value. There are traders that don't care a damn about value. They just want to buy things or sell them based on short-term movements, like Ken Griffin. Then there are speculators, and speculators take the opposite side of hedgers, right? Hedgers exist, like oil and gas companies must sell their future production. So the speculators buy it because they have to take the other side. But then there's gamblers. And then there's degenerate gamblers. And degenerate gamblers are people who only buy stuff because the price is moving with money that isn't theirs, so they have no ownership of it. And it's like going to Vegas and you win on the first hand. If you keep playing, you will go home poor. If you stop, you can win. But the odds are against you. And investing is about playing the odds and buying things below their value. Gambling is hoping some greater fool takes you out. And I think we've seen a lot of that in crypto today.
And we saw it in crypto, but we also saw it in the traditional markets as well.
Oh, for sure.
Right.
For sure. So, and worse, in the traditional markets, and this is partly why Bitcoin in particular is getting hammered right now, is we had the highest level of leverage in traditional markets in history. So every brokerage firm in the world would give you free margin debt, and people were margining up their stocks because stocks only go up. David with his green fucking hammer. And it was so bad. I mean, the guy picks tiles out of a Scrabble bag and freaking Redditors buy the stuff. It just made my head hurt. But that was going on, and the whole meme stock thing. And so you got this wave, and it pushed valuations to Stupidville. Like my son's company, Snowflake, traded at 200 times revenues. No stock should ever sell at 10 times revenues. Forget 100 times revenues like Zoom and Pellafrickin-Ton. I mean, it's down 90%, and it could still go down 75% and be expensive. So the thing is, that market became so over-levered that once it started to crack, the margin calls come in, and in a margin call, you're forced to sell not what you want to sell, you sell what you have to sell, Bitcoin, gold, and bonds. So that's why bonds, Bitcoin got slammed from November to today. And now when I look at it, I look at NASDAQ and I say, well, NASDAQ is only been more expensive in 8% of history. So it's in the 92nd percentile after falling 35%. So it's still in the 92nd percentile expensive, whereas Bitcoin is in the 94th percentile cheap.
Interesting. And a lot of people talk about this, Bitcoin as a safe haven, or it's a hedge against inflation, and these sorts of things, right?
Sure.
And so what you're outlining for us with, the low and the high essentially related to Bitcoin versus the market, it sounds to speak to
Well,
that.
you got to zoom out, right? So Bitcoin started 13 years ago, and from a science project, it's worth $600 billion. Let's give ourselves a hand on that one. That's pretty amazing. So $600 billion. And more importantly, if you look at how we price it, that's the important thing. So one Bitcoin is one Bitcoin. But we don't talk about it in Bitcoin. We talk about it in dollars. Well, here we talk about dollars. In Russia, they talk about it in rubles. In Argentina, they talk about it in pesos. In Venezuela, they talk about it in bolivars. There has never been a bear market in the Bitcoin price in Argentina. Not once. Because peso has been turned into toilet paper. There has never once been a bear market in Venezuela and bolivars because there's been a bear market in the ruble. So we price in dollars. Now the dollar, has been in an inexorable decline since 1913. From 1776 to 1913, a dollar, we stole it from the Rothschilds, because basically the Rothschilds own everything in the world. And so the Rothschilds started the central bank in 1600s. The Bank of England, the House of Rothschild split. Some of the Rothschilds went to England. They set up the Bank of England in 1703. And then we borrowed that same model to create the Fed in 1913. So when we had to create a currency for America, we picked the dollar. It was called the, there's some other word that goes before it in Dutch, but I can't remember. It's like kriksdollar. But long story short, so we created the dollar, and it was worth $1 from 1776 to 1913. There was no inflation. Inflation is not good for you, by the way. It is theft. It is intentional theft by central banks to steal the wealth from the masses to give to the few. And that's what the Rothschilds have been doing for centuries. And so this idea of inflation didn't exist until the creation of the central bank. So John D. Rockefeller and J.P. Morgan got together using Amory Aldrich. Go back and Google Amory Aldrich, the Aldrich Plan, and look at the picture tonight of the vampire squid. It's awesome. And so they created this thing, and since 1913, you used to be able to buy 20 Snickers bars for $1. Now you can't buy one. Okay, so we turned $1, like Jay Leno used to say, I heard they were going to mint a dollar coin. So we already have it. It's called a nickel. So the key is we turned it into toilet paper, and everyone says, oh no, the dollar's strong, Mark, look at Dixie. No, Dixie is 2/3 euro, a bunch of yen, which are both worse toilet paper than the dollar, and a little bit of other stuff. Against the renminbi, the last 2 years, the dollar's actually down. She says, that's not right. Yes, it is. So China's playing a different game. It's a whole nother tale for another day. But the currency devaluation that really started in 1971 when Klaus Schwab created the WEF, the lobbying organization to bring in the New World Order, whole nother conversation. So they started the deal where we cut a deal with Saudi to protect Saudi at all costs in exchange for pricing all transactions in the world in dollars, oil transactions. And anyone who threatened that was made to disappear. Iraq wanted to price it in euros, Gaddafi's gone. I mean, not Gaddafi, Saddam Hussein gone. And then Gaddafi wanted to do it in gold, he had to disappear. Well, the problem is if China or Russia price in rubles or yen, they have nukes, so we can't make them disappear. So what we do is we devalue the currency, so Bitcoin is higher today than any time in history except 6% of the time. And that is because the dollar is getting less good. Like, you guys see it here too. Real estate prices are up, right? No. Your house did not grow. It did not get more efficient. It actually started to wear out. What happens, at least it's different here because you have lots of wealth and it's supply and demand. But where I live in North Carolina, there's just not that much excess demand. So it's the fact that the dollar that we price the land in is devaluing. And so Bitcoin doesn't get better, it just stays what it is. but the dollar that it's priced in gets worse. But in the short run, you have greed, which was November, where the fair value of the network, according to Metcalfe's law, was about 33 grand. We got to 69. That was greed, excess speculation, and leverage, 100 to 1 leverage. Like my little brother, I shouldn't tell the story, he lives here. And he told me a couple months ago, they stole my Bitcoin. I'm like, what? He says, well, I was at BitMEX. I'm like, stop. Okay, dude. You levered up your Bitcoin. You didn't make the margin call. No, they stole it. I'm like, no, you're an idiot, and you lost your Bitcoin. They did not steal it. Now, someone told me that maybe that's their plan, to incent people to lever up their Bitcoin, and then they take, I'm like, oh, maybe that is a plan. So, but that leverage is now mostly out of the system. Much of the leverage is out of the traditional system. So I think the downward pressure on Bitcoin is going to abate. The problem is Luna really hurt confidence in the other protocol layers. And I think those are going to continue to unwind for a little while.
Yeah. Mark, I feel like we could talk for hours.
Yeah, I've overstayed my welcome.
No, this has been awesome. We have another panel that you're going to be on anyway.
Oh,
so
good. So I don't even have to move.
Yeah, you don't even have to move. We're going to bring the panel
I'm just going to
to
stay
you.
here all day. I'll be here all day.
But please give Mark Yusko a round of applause. That was awesome. While we wait for the others to come on, what do you see as kind of, I asked this at an earlier panel, like what's the next horizon or what's the next milestone for
well, I mean, the word of the day is Web3. So, we've shifted. Our first fund was all about infrastructure, and we do 70% in equity, 30% in liquid protocols. Fund 1, we buy liquid protocols as venture capital investments. We don't trade them, we buy them and hold them. So in Fund 1, we bought Bitcoin, which we thought was a Series B, Ethereum, which we thought was a Series A, Solana, which was pre-seed, and the Graph, which was pre-seed. Both of them have done okay, although today pretty bad for Solana. Fund 2, we made a mistake. I don't speak for my partners, became kind of maxi. So we missed a bunch of DeFi opportunities that we had a chance to do, so we bought a lot of Bitcoin. Fund 3, we're going to be much more diversified, and so I think play to earn, play to own I like better even than play to earn. Anything to do with gaming, I've got to meet Rahul and those guys. I love gaming. And I just think that all of this ownership economy, Web 2 was clearly about forming communities. But the communities were run by feudal overlords and all the money went to them. Web 3 is about communities turning into economies, and that's awesome.
Definitely. Mark, thank you so much. Another round of applause for Mark. And let's